Well, welcome to 2025, The Big Idea. And we have the top team of Citi in our studios to try and understand how is it that they think about the year ahead. We used to do a quarterly conversation with them about how results have gone by. But at the start of the year, it's pertinent to talk about how does the Citi think tank think about 2025 as a year. With me, Surendra Goyal, Head of India Research at Citi. Kunal Shah, Director of Indian Banks and Financials at Citi. Arvind Sharma, Director of India Autos and Transportation, and Rashi Chopra, Director, India Metals and Cement. All of you, thank you so much for taking the time out. Absolute delight to have you. And I think it's just pertinent to talk about 2025 because if people were cribbing about how Indian markets are not giving the opportunity, maybe, just maybe, this dip gives the opportunity. Surendra, let me start with you. And on hindsight, while you may not have changed your targets, etc., but suddenly a target of 26,000 makes you sound bullish related to what's happening in the markets and others. Tell us about how do you think about 2025 as a year for Indian markets?
Sure. Thanks for having us on the show. And just to give some context to the target, when towards the end of last year, the market was at more than 25,000, our target was still 25,000. So we rolled it forward and now it's 26,000. Yeah. So we are more constructive on the market compared to say 3 months and 6 months back. And it's a combination of 2-3 reasons which are kind of playing out together for being more constructive. Firstly, if you look at the growth slowdown that we have had, say over the last 6 to 9 months, firstly, public capex was slow, government capex was slow for a bit. So that in December saw a good recovery and should improve going forward. Secondly, the budget did provide the tax cuts and interest rate also. We have seen cuts and we are expecting more cuts as we go forward. So I think a lot of those things should help growth as we go forward from here. And which is why at a overall earnings growth trajectory, Nifty earnings growth trajectory, we are expecting the low to mid single digit growth this year to improve to low double digit growth in the coming year. So that is the first argument. Secondly, valuations. There has been a fair bit of a pullback. Nifty had gone to even 22 times 1 year forward. Now we are below 19 times 1 year forward. So I think, and that's like the 5-year average, 19 times. So in that context, it is a lot more reasonable level. And the third thing I would say that large caps, there are enough stocks where valuations are now becoming more reasonable. So compared to our view, say some time back, we are more constructive and that is what is reflected in the 12-13% upside that we have on the market from current levels. Having said that, I would also add a point that there is still a fair bit of uncertainty on the global side, right? There are so many announcements or comments on tariffs, right? And I think you need some kind of clarity to come on that point. That will give the market comfort because what has happened between November and now is a stronger dollar has resulted in EM outflows, and then even within that, India was a more expensive market with a bit of a cyclical growth slowdown. So everything, that is what has impacted Indian markets. And now going forward, it looks a better kind of a situation compared to say 3 months or 6 months back.
Interesting. If 2023 and 24 were years of US exceptionalism, it doesn't seem that 2025 will be any different, even if it's concentrated for now. But my question is largely this, Surendra. When a global money manager sitting out of Chicago or New York is getting 4.5 fixed, plus currency, plus the equity risk premium missing, why would that investor want to come to an emerging market or India? And if the FI flow is not coming back, I mean, if US interest rates were to rise, who knows, then that makes the case even worse, if you will. So if the FI investor is not coming back, can Indian markets on the back of the domestic flows still give a reasonable return, or is it a difficult argument?
Yeah, so a couple of points there, Niraj. So this discussion always comes in when we have a correction. And despite that, the Indian market in the longer term has continued to compound fairly well. And these questions typically come in when there is a lot of pessimism. Okay. Right? Finally, what do investors come to India for? You have a GDP growth, which we expect to be, say, close to 6.5% going forward, which is the best, one of the best in the world, at least among the major markets, right? And Indian companies are generally good at converting that to earnings growth. If you look at the 10-year growth CAGR of, say, Nifty or any broad-based index, it will be like anywhere between 11 to 13%. So that is what people come in for. There will be situations, short-term events where the currency depreciates a lot, so it becomes more difficult. Flows, and we have seen foreign flows. They have been volatile. If you look at the last 4 years' data, there have been months of significant outflows, couple of months, and then you see stability and then money comes in again. So I think that would be kind of taking it too far, because we have seen this play out so many times. If the underlying growth improves, okay, and things stabilize a little bit on the global front, I think that's a clear situation for money to come back in India, even on the foreign side.
Cross fingers.
And last point, I think you started by saying US. So I think even in the US, it's been one theme which has been dominating. It's not a very broad-based market performance, right?
That's true.
And even there, I think with what happened with Deepseek and so on, we'll really need to see how that plays out. I don't think it's a given that everything continues to play out the way it's played out in the last couple of years.
By the way, at some point of time in the show, we'll talk about that, because I think the word for 2025 got set in January itself, Deepseek. I think that's probably the biggest telling point. But okay, if FIs were to come back, one of the larger sectors that they might want to come back is BFSI, because for the longest time, very well valued, aayega paisa, it hasn't come thus far. But we're seeing signs of that, right? Signs of there being some demand at the tape, wherein companies have delivered numbers. I mean, Bajaj Finance, a case in point, some others. How constructive are you relative to how you have been over the last 2 or 3 quarters on BFSI at large?
So overall, on growth side, definitely when we look at it, as Surendra was highlighting, with respect to the tax cuts that will help in terms of the consumption and the retail finance demand. Even if there is some uptick on the capex, the overall corporate credit, which has been in say somewhere high single digit, we could see some uptick out there. And in initiatives which were taken by RBI to manage the unsecured portfolio, we have already seen steep moderation out there. It seems like largely that base is set, and on that we will see relatively better growth on the unsecured side going forward. So all this can actually lead to a percentage point or 2 higher credit growth than where we are today. And many of the players, and that's where maybe we turned positive on Bajaj, we turned positive on Kotak as well, because we clearly saw the visibility in terms of growth, wherein they would outperform the industry average by a significant number. So Bajaj, we are still confident, like easily 25% plus is something which will continue for next 3 years. Kotak also, we are pretty confident that they can give like more than 15% growth. And the last quarter also, their growth was amongst the highest in the private banks. So these 2 stocks in particular from the growth perspective.
Okay, but large banks at large, or large financials at large, Kunal, you would reckon that they are in a safe space right now from a valuation perspective? Would that be a fair assessment?
Yeah, so when we look at it in terms of the historical valuation, last 5 years average, we are trading at almost 20% discount to that. Okay, and when we look at it in terms of the asset quality noise, which was there, now it's almost factored into the estimates as well for FY26, FY27. If growth picks up, now the only thing that needs to be watched out is margin behavior amidst the rate cut. But if it's a shallow rate cut, it should not have that much of an impact. And everyone has displayed operating efficiency. So when you look at it in terms of the ROA, that is something which has surprised quite positively. Despite maybe the noise around asset quality, growth and all, large banks have been able to manage the ROA profile. But still valuations are like almost 20% down from 5 years average. So to that extent, there is definitely the room.
Okay, and just one follow-up. On the banking space, the pecking order, you mentioned Kotak, of course, that seems to be number 1 on your list?
Yeah, and ICICI and HDFC are the other ones, so we stick to that, yeah.
You stick into the large ones. Okay, I'll come back on some of the other aspects as well. But Rashi, let me get you in. I mean, and again, I'm not completely sure of the valuations, but if we can talk about banking as being below 5-year averages, maybe some of the cement names, and let's start with that, because I'll get to tariffs in a moment with both you and Arvind. But cement maybe, again, a sector which virtually has gone nowhere, right? Now, if government capex has picked up, and at some point of time, if private capex were to come back, is cement in a sweet spot, or are you negative?
Cement is in a sweet spot, but I think it'll have to be a little bit of a selective sweet spot, in the sense that, of course, we've had a low base here. The first 9 months demand hasn't really gone anywhere. But now, like we're hearing, December demand was better than November, January's been better than December, and things are clearly picking up. So in that sense, I think the growth trajectory becomes like a clear-cut one, and we're not even exposed to like global sort of, it's not exported or anything like that. It's all domestic demand in a way. Second thing is that we need to play the stocks which are essentially kind of levered or, prepared to play for this growth with the cost efficiencies kind of playing out. Because despite demand moving up, the general thought process, or at least our view, is that pricing may not necessarily move up significantly. And that's because a lot of the capacity is again being added by the larger players, so that fight for market share still remains. So we need to kind of focus on the growth plays with, the cost benefits. So I think the players which are like the strong ones will continue to remain, like the valuations have come off a little bit, but not significantly. But there's a reason why they're kind of holding up. And they become a safe place to kind of be in. So stocks like Ultratech, for example, trades at about $180 a ton today. But I'd still say that would be our top pick, because you're getting growth there, you're getting cost, and you're continuing to see the benefits of consolidation, and the acquisitions that they're making.
Got it. A follow-up there. Would market cap by capacity or EV per ton be the preferred way in which you gauge companies currently? Part one of my question is that, because capacities are coming up, if you will, and therefore for a lot of companies, they might look cheaper than what they were 5 years ago. And just question to roll into that. A lot of people are preferring some specific regional plays. I mean, investors tell me, for example, that they are bullish on the Andhra-focused companies because of the Amravati setup, etc., and stuff like that. Are you kind of constructive with themes like that?
Sure. So firstly, on the EV per ton valuation, I think it just becomes like an easy benchmark to kind of look at. We know replacement cost, again, depending on the dollar value, is probably somewhere around $90, $95 today. As we speak, and like I said, Ultratech trades at 180, right? So how does one kind of say that, one should still buy it? But in the context of the fact that they're continuing to grow, the market is obviously giving them that value. Then we have stocks like, ACC, where we also have a buy, but they trade at like $80. Dalmia trades at $80. And it's very clear, visibly so, that there's not a lot of growth visibility coming out of here. So the market is willing to give them a price around replacement cost. Right? So it just becomes like an easy metric to kind of work with. Of course, we work with EV, EBITDA on our valuations when we value the company. But then again, it's, 5-year averages, 10-year averages, what is the context of the market? But growth becomes the key parameter over here. Secondly, on the South, obviously there's a lot of expectation around growth. A lot of the M&A activity that you've seen has happened with the South-based companies. They've been the acquisition targets. Having said that, pricing has been most volatile in the South and the Eastern markets. So again, I won't be very nitpicking on these Southern players just because they're in the South. They have to kind of come with the other criteria to make them work.
Okay. And then to tariffs, and question to both of you specifically on your themes. But Surendra, can I just briefly, before I get to Arvind, because I have a bunch of questions for him. But tariffs by and large, I mean, everybody's talking about how the next couple of quarters, forget fundamentals, forget valuations, focus on where Trump is going, where the tariffs are coming, and that will be the key point. Now, he's said April 2nd, key reciprocal tariffs coming in. How big a negative for a clutch of sectors, including pharmaceuticals or some of the others, including the pockets that Rashi and Arvind track as well, how big an impact could that be?
Sure. So I think the first thing I would say is there are still a lot of unknowns and uncertainties around that. So like whatever I say is kind of making certain assumptions. Everything could change, right? Like it could change tomorrow, for example, right? But the point I'm trying to make here is, like, if you look at some of the sectors which are more commonly talked about, you will also have to keep in mind angles like, say, let's take an example of pharma, right? Generic pharma, a lot of the supply in the US is from India, right? So how does it really impact the cost there? Because these companies don't make very high margins. So at some point, they have to pass it on to the channel and eventually to the consumer. So then how does it really work? Because it will lead to healthcare inflation. So that's the other thing to keep in mind. Like, let's take chemicals. I think there it also becomes important to keep in mind which are the other countries which manufacture chemicals and supply to the US? And how does it change the relative competitive positioning between those countries? Right? So I think there are just too many unknowns at this point of time to be making a very informed decision. And then some of the other sectors where there is a tariff differential, like agri products or say jewelry, not a lot of the major listed players have an exposure there, at least to the US. So firstly, I would say India still looks relatively better placed versus a lot of other countries as far as the tariff is concerned. But there are uncertainties, and that is what I think the market is clearly pricing in, and that is why there is a lot of nervousness, and depending on the comments that come out, stocks and sectors do move.
Okay. Well,
and then finally, like, of course, like again, one of the things we'll also have to see is this more for negotiations? So what happens? That's the other angle. There is a talk of a bilateral trade agreement by, say, fall of this year. So I think a lot of those things are very unknown right now. So having a very clear picture, I don't think we'll get it at least in the next month or two.
Got it, yeah. If Mexico and Canada, anything to go by, some of it is negotiating tactics as well. One certainly hopes that stays that way. But it puts autos firmly in the thick of things, not tariffs per se, or not just tariffs, but everything that's happening around what India could do vis-a-vis global majors, setting up shop, etc. in India. Let me start with the bigger macro picture first. Then I would also love to understand from you how you thought of earnings gone by. But how big a problem could it be for Indian automakers, particularly car companies, if large global majors set up shop in India? It's not that it's not happened in the past.
Sure. If you see till now, I'm talking about say, January or December, EVs in India from the Indian companies were aimed more towards people looking at value, total cost of ownership. But in the Auto Expo and over the last couple of months, we've seen companies launching more high-end models. We are targeting people who are, who want more premium cars, better features, connectivity, and the likes. And therefore, they're at a higher price point also. So if we have global companies setting up shops in India, obviously their cars would be priced at a slightly higher point, right? So they are also targeting the same clientele that some of these recent models are targeting. So naturally, competition is going to heat up. Again, manufacturing in India, how much localization do these companies do versus, say, companies in India who already have a very strong vendor network. It's not just batteries and motors. Obviously, they are high-cost items. But apart from that, the vendor network that these legacy companies in India have, the footprint, the sales footprint that these companies have, gives them an edge. But again, you're talking about customers, if they are looking at more premium-end electric vehicles, naturally the competition heats up, puts a pressure on pricing and therefore margins. Again, PLI is something that some of these Indian companies have. So PLI helps them become more competitive, 10, 12%, whatever they get from the government. So the government has taken these steps in the past to protect the interests of Indian companies. Nevertheless, and it's again a situation which is still evolving. If you have global companies coming in India, setting up shop, maybe take a bit of a hit on the pricing, but try to gain market share, it is going to heat up the competition quite a lot.
Okay, so we were wondering about why is it that despite selling 30,000 EV vehicles on the day of the launch, M&M got beaten down in Monday straight, so on and so forth, right? We were talking to Anish Shah yesterday at the conclave. He was fairly confident of not just them, but every Indian company beating up or standing up to competition. What is already captured in the price for some of the four-wheeler auto companies when it comes to this? And what did you make of the results? Because Maruti's numbers, December, Jan, look rock solid. M&M's December quarter numbers look very good. What have you made of the four-wheeler numbers and the commentary?
Sure. So, in our top picks, we have both Maruti, Mahindra, and Hyundai. So, we are clearly very constructive on the four-wheeler space. And I think numbers have been better over the last couple of months. Even in sub-segments, even like hatchbacks and cars, which were weak for probably last 3 or 4 years, we've seen some sort of a stability, if not a revival. So to that extent, yes, things are reviving. Of course, there's a large base, so our YOY growth number might seem a little underwhelming at low to mid-single digit. But clearly, we have seen a revival in the numbers, especially in passenger vehicles. But again, all these three companies, Maruti, Mahindra, and Hyundai, they have launched their born electric vehicles just last couple of months. So naturally, they are playing into a space which till now was not well discovered in India. Models we've had till now were more ICE models or ICE platforms converted to EVs.
Right.
Apart from some of the, again, global companies which had a few models. But most of these companies, the Indian majors, had ICE model converted to EVs. You talked about Mahindra and the launch. It's probably for the first time we are having a born electric vehicle coming into the market. Yeah. And perhaps the benchmark is set up by the previous models where you had 50, 60,000, 100,000 numbers in the first hour of booking. I guess that benchmark will have to be recalibrated. We're talking about a different price point, a different customer segment, and not only a product, but even a segment which has not been tried by customers, right? So it will take some time to play out. So, let's see how the actual volumes pan out. It's still 5,000 a month, the capacity, so they are 30,000 in a way. Theoretically, 6 months of bookings have been done. Let's see how it plays out once the car is on the road, what's the feedback, what's the word of mouth publicity. I think those things will play out.
Maybe just to add to that, your question was more on Indian companies kind of holding up to competition. See, I think from a market perspective, the market always cares about increased fragmentation in any industry. Indian companies may hold up, right? Just look at the example of what's played out in paints. The incumbent might still end up 2 years, 3 years later being like the strongest player in the market, but the market, in the market business, but the stock market still cares about increasing competition and increasing fragmentation. And that does impact stocks, at least in the short term. So I think that's a point to case. So Indian companies could well hold up, they might do very well, but I think the market will be nervous about if there is a risk of increasing competition.
And this could be across sectors, not just autos, but it's interesting that with that in mind as well, he still has an overweight or the buy list on all the 3 large companies. So that is very, very interesting to note as well. Okay, speaking of tariffs, by the way, you can't not talk about metals, right? I mean, and what's the thought there? Please help us understand how you think about this whole situation.
It's a tough one.
Of course, which is why I'm asking you.
One. See, like you mentioned, when it's Mexico and Canada, it's essentially to get a deal, right? So, for example, in aluminium, the US imports about 70% of their aluminium. About 25% of their steel is all under imports, right? And on steel as well, when 232 was sort of implemented earlier, there were a lot of exemptions that came through. And at the moment, I think really only 18% gets taxed over there. So the question is, will it stay or will there be exemptions? Number one. Hypothetically, if it were to stay, right, at the moment, like from an aluminium perspective, Hindalco has been quite confident that at the moment they benefit from the premiums rising. And in their view, the exemptions will come and they won't stay. From a pure India perspective, right, and again from a reciprocal tariff perspective, etc., we're not really exposed from an export market perspective. India exports about almost like 230 to 250,000 tons of steel to the US because in any case, there's a tariff, a 25% tariff on India. From aluminium side, it's a 100 KT exposure. Sorry. And the only place again where reciprocal tariffs become important is thermal coal and coking coal. Sorry, because we import about 10 million odd thermal coal, 10 million odd coking coal. So I think that becomes a question mark. But then, there are alternate sources of coal that are available globally. So it's still all a big question mark. But purely from a, sort of a reciprocal tariff perspective also, I don't think the implications are very significant purely on tariffs.
Okay.
From an Indian equity perspective, we are still negative on steel as a sector. Because we're still sort of, banking on, or rather the view is that there's not a lot happening in China at this point in time. I think the market is still hopeful that something will come up on the safeguard side, which is why the stocks are kind of, in a range. And I'm not sure necessarily reacting completely to the tariffs. I mean, the volatility is there, but I think it's on the one side is something happening on the tariffs, the other side is something happening on the Indian government doing something about safeguard and protectionism. But, we are still sort of the view that maybe nothing will really come significantly on the safeguard side because, inflation is a big question mark as well.
Okay, well, in which case, well, for a clutch of sectors, a lot of these things might be negotiating tactics. Okay, fair call. Last 2 questions. The last one is on Deepseek, the second last one. I'm asking you to pick between 2, whichever you want to talk about. the quantum of coverage that you may have on non-lending financials, and if that is something that falls within your ambit. And if not, you've spoken to us about large cap financials. What about the second tier? Is there some merit in trying to own them? A lot of people are saying that the valuations, for example, on an IndusInd, 1x book, if something happens on MFIs because the new RBI government might be relaxing the norms a little bit, a lot of those stocks could benefit as well. Any thoughts?
So on second tier, when we look at it, it's still better to stay with the secured lenders rather than the lenders who are more focused on the unsecured side.
Okay.
So there are players who have more than 95% exposure towards the secured lending in the second tier. And that would be the preferred bets, given that they are also available at reasonable valuations of 1.2, 1.3x. And when we look at it, in fact, for MFI in particular, what we gauged from the conference that we had last week, in fact, the pain is going to continue in 4Q as well. And we need to see in terms of 1Q, the implementation of MFIN 2.0 guardrails, how much is the disruption. So no doubt, a lot of pain has already got recognized, provided for. To that extent, it might come off, but still they are not out of the woods. Okay, so to that extent, maybe rather. And on the unsecured side, when we look at it on the personal loans, we are seeing some pain to cool off. But on the secured, there doesn't seem to be too much of worry, even on the asset quality side. And they might be able to participate on the growth as well. So would prefer more of a secured lenders compared to maybe the players who have exposure to the unsecured ones.
And still the pecking order will be large cap financials, and then maybe the second tier secured lenders. And then the unsecured ones, if at all. Okay, fine. Perfect. Thanks for that. The final word, and the big idea for 2025, did China set it up in January itself? Deepseek. And the flutter that is brought about in the AI world. What have you thought about it? Because you look at tech so closely. Sadly, we haven't even spoken about Capgemini and the impact that it had on Indian IT. Today, IT sector is down as well, etc. But just a brief on IT and Deepseek before we wrap up.
Sure. And before that, I think, like on the market outlook, one of the points I missed out is that the weightage of FIIs versus the emerging market benchmark is the underweight is among the highest in the last 20 years. Okay, so the positioning from a FII perspective is also the lightest that we have seen in a long, long time.
And typically, does that bring about a change? I mean, is that a cue at times, Surendra?
Again, India historically has mostly been overweight. Of course, the benchmark weight has gone up. But like compared to, say, a year back, when there was a big overweight, today there is a significant underweight. And that, to that extent, at least from an ownership perspective, it's definitely light, and helps, of course, flows are very difficult to predict, but it kind of provides a relatively more favorable kind of a setup going forward.
Got it.
Now, on your question on tech, again, Deepseek, obviously, I'm not an expert. The only point I would make is, rather than commenting on Deepseek, I think open source models in general could kind of change things very meaningfully. Right, everything, right? The capex and the cost of compute, everything can change. And how it really impacts IT spending of clients, does it free up some room for growth in some of the other areas of tech? I think a lot of those questions are a debate right now. Still too early, there is a fair bit of debate on the topic. So we'll really have to see how this plays out going forward. On IT services, again, very factually, I think the guidance yesterday was below what the market was or consensus was expecting in Europe, and which is why there was a bit of a disappointment. But in IT, what we have been saying, like at least for Indian IT, is we see a very moderate improvement in growth in FY26, and valuations in that context are still on the higher side, right? If you look at this year, all the companies we cover put together, the growth should be around 4%, FY25. Next year, it's 5.5%, 6%. So that's still a very slow recovery. And for that, the IT index is trading at maybe 28, 29 times 1 year forward. And that has been our bigger concern on these stocks. And that concern still remains.
Well, on a big idea show with a note of concern around a particular sector, but maybe some optimism around specific pockets and on tariffs. To the lady and the gentleman, thank you so much for joining in today and giving us your thoughts. Really appreciate your time.
Thank you.
And viewers, thanks so much for tuning in to 2025, The Big Idea with the Citi Think Tank.